Right, hopefully you can hear us now, Alison. We're just kicking off. Good afternoon, everyone. Thanks for joining us this afternoon. My name's Heidi Buckingham. I'm a sales and distribution consultant here at Zurich. And this afternoon, we've got a webinar on cyber risk and cyber risk transfer. And our presenters this afternoon are Rory Spires, who's a cyber risk consultant from Zurich Resilient Solutions, and James Donald, who's a cyber underwriter at Zurich. Just a couple of housekeeping bits and pieces before we kick off properly. So, as I mentioned, the webinar is being recorded this afternoon. I'll send out a copy of the recording afterwards, and feel free to forward that on to any of your colleagues who are interested, as well as a copy of the slides. Everyone's in listen-only mode, so if you do have any questions throughout the course of the webinar, please feel free to just pop them in the chat box, and we'll answer them at the end. And I'll also send out a feedback survey afterwards, which we'd be really grateful if you could fill in, especially to let us know future topics that you'd be interested in us running webinars on. And with that, I will hand over to Rory to get going. Thank you.
Thank you, Heidi. So afternoon, everybody. So today, me and James are going to take you through cyber risk and cyber risk transfer. Before jumping in, a quick little background about myself. So I'm Rory Spires, cyber risk consultant here at ZRS. I support the cyber underwriters like James in better understanding the cyber risk of large and complex client environments and aiding them with that risk transfer. But I also provide cyber risk and consultancy to other organisations, helping them with their cyber risk management. And then prior to joining ZRS, I worked at the Department for Work and Pensions as a senior security analyst. And then prior to that, again, I was in the intelligence corps in the British Army as a threat intelligence analyst. So today we're going to talk to you around cyber risk, the cyber threat horizon. And first of all, I also want to talk to you about why we're talking about it. So this table here is from the Global Risk Report 2022. And this little snippet is from the opinion survey for national risk perceptions. The question posed was, what 5 risks will pose a critical threat to the country in the next 2 years? And in the UK, failure of cybersecurity measures was the most frequently selected risk. There were a few reasons for this, namely the growing dependency on digital systems, and this was really intensified by COVID-19 as it pretty much altered societies. Industries have undergone rapid digitalization. Workers have shifted to remote working where possible. Platforms and devices that are facilitating this change have really proliferated. And at the same time, cybersecurity threats are growing. They're outpacing our ability to effectively manage and secure them. There are also sophisticated cyber attacking tools out there for threat actors to use, meaning they can attack targets of choice more efficiently rather than just settling for targets of opportunity, really highlighting the potential to carry out more goal-oriented attacks that it's going to lead to an even higher financial, societal, and reputational costs in the future. Another issue is that IT and cybersecurity professionals, they're already stretched. They're under an increasing burden, not from just that digitalization that I'm talking about, but the growing complexity of regulations for data and privacy. And even though such regulations are critical to ensuring public trust in digital systems, it is an issue. But these are just some of the factors as to why cybersecurity is seen as the biggest risk to the UK and why we're discussing it here today. So before jumping on, I want to talk a little bit around the cyber risk management and what it is. So it's the cornerstone of cybersecurity, really. Everything comes back to risk, and it can be described as possible future outcomes that we describe in terms of the chances of occurrence and what impact they would have upon us. And then the primary goal of that then is to bring risks within appetite. What level that actually is depends on the organisation, the value of its assets, its budget, among many other factors. But it's key to know that it's impossible to actually design and deploy a totally risk-free environment. However, significant risk reduction is possible, even with modest effort. And all risks are evaluated upon the threat that they pose against one or more of the CIA triad, which is on your screen there. So these are the primary goals of cybersecurity: confidentiality, integrity, and availability. Confidentiality being the concept of ensuring the secrecy of data, The goal is to prevent unauthorized access to that data. Integrity is the concept of protecting the reliability and correctness of that data. And availability is the means authorized users are granted timely and uninterrupted access to data. So when somebody wants to get hold of something, they can get hold of it when they want to get hold of something. And if it doesn't impact against those three, then the confidentiality, integrity, or the availability of an asset, then it isn't a cybersecurity risk. And then when it comes to risk treatment, there are 4 different methods to tackling it. So you have avoid, mitigate, accept, and transfer. So avoid, this is the process of selecting an alternative option or activity that has less associated risk. So the example here that's always given is don't build your data center in Florida, build it in Arizona instead, and then you avoid the risk of hurricanes, for example. Mitigation. So that's the implementation of safeguards, security controls, and countermeasures to reduce vulnerabilities or block threats. And I'll discuss later how ZRS can help mitigate cyber risk. Then you have acceptance. So this is the result, say, after conducting cost-benefit analysis, which shows that countermeasures would outweigh the possible cost of any loss. So the controls will cost more than any potential impact, and also that management has agreed to accept the potential consequences. And then risk transfer, which is the placement of loss due to risk onto another entity or organization, such as cyber insurance, which James will talk about shortly. So this graphic here is the Cybersecurity Breaches Survey 2022, and it highlights, well, identifies breaches or attacks that have occurred in the last 12 months. So this shows that around 4 in 10 businesses, so 39%, and 3 in 10 charities, 30% have reported having come under some kind of security breach or attack in the last 12 months. It shows that large businesses are more likely to identify breaches or attacks than smaller ones, and this has been consistent, really. It's been a consistent pattern over the last few years the survey has taken place, but it must be taken into consideration that these larger organizations, they're going to have better monitoring capabilities in place, so they'll be in a much better position to actually identify whether they've been attacked or not. And something that I've seen personally within the media is that smaller organizations are being targeted. Just because you're a small organization doesn't mean you're not going to be targeted. In fact, they're easier to target because they have less resources, but they also do have the finances in place to pay some sort of ransom as well. So they are targeted. So that last slide identifies that organizations are being attacked, but who's attacking them and why they're doing it. So an article from The Economist, which was just one of many different sources that were saying the same thing, that the most valuable resource in the world is no longer oil and it's data. I can't remember the exact monetary value they put on it, but it was in the billions and billions of dollars of how much data is worth these days. So it's easy to see why organizations are being targeted for their data, because it can be sold, but that's not the only way a cyber attack can be monetized. Different threat actors have different motivations and different ways of extorting money. But when we think of a cyber attack, we're predominantly thinking of cyber criminals. These are the individuals that they're out there for the financial gain, stealing your data, compromising the availability of your systems through ransomware, forcing you to pay the ransom. But these aren't the only motivations they may have. There are many out there might be gathering intelligence or trying to gain competitive advantages. Those are just a few. Another potential external threat is hacktivists. So these differ from cyber criminals in their motivation. So hacktivists are politically and socially motivated. So they might target an organization, for example, as they are harming the environment, or they have political ties to an organization or a government that the hacktivists disagree with. The best example of this would be the Anonymous Hacking Group, who targeted organizations who it deemed weren't doing enough to support Ukraine in the conflict with Russia. But not all threats to an organization are external. They also face internal threats. And these tend to take 2 forms. First is malicious insiders. So insiders that are purposely trying to damage systems or exfiltrate data. And these are a real threat because they actually have authorized access to systems, and they tend to have the knowledge of how the systems work, how best to cause the most damage, or how to exfiltrate without actually being caught. But then there are those that make honest mistakes, be that misconfiguring databases or sending data to the wrong person. So we've seen that organizations are being attacked. We've seen who's doing it. And again, this graphic comes from the Cybersecurity Breaches Survey. It just pulls out the types of attacks and breaches that organizations are seeing. And as you can see, by far the largest is phishing. So staff receiving fraudulent emails or being directed to fraudulent websites. And this really highlights the importance of staff vigilance, given that most cyber actors use social engineering techniques to gain access to that target organization network, and really shows the importance of having cyber awareness and training strategy in place. But what the graphic doesn't really show is phishing is the largest attack vector. So attackers use phishing to gain initial access to a system. So some of these other attacks and breaches, for example, ransomware, could follow on from a phishing attack. So it doesn't show that correlation very well, but it does pull out the fact that phishing attacks is the largest attack vector out there, which is something that we're keen to highlight. So moving on from that, I just want to highlight some of the cyber attacks that we've seen recently. I've pulled these out at random. There are hundreds to choose from out there. The first one being the Indian energy company Tata. They confirmed they were targeted by a cyber attack. So, and this is, I wanted to pull this one out because it's an example, another example, particularly globally, of critical national infrastructure being targeted. And this is likely due to the potential impact that an attack on an organization like this would have on people. Because the impact on people would be so large, attackers would like to think it increases the likelihood that a ransom would be paid. But other potential motivations are to instigate political instability, for example. Another example is South Staffordshire Water. So a couple of months ago, they were hit by a cyber attack, and the ransomware group claimed that it was possible to tamper with the chemical composition of the water supply, something that the water company themselves dispute and say it would be very hard to do. It would take a very sophisticated attack. But it does set a concerning precedent because it's not the first time we've seen this. An attack similar to this happened in the United States, where they said they could change the composition of the water supply. But again, it sets that concerning precedent that when it comes to monetizing cyber attacks, attackers are looking for that potential impact. It's not just going to be reputational damage or financial damage, it's the safety of people. Next, we have Interserve. So they've just been fined. They're a construction company, and they've just been fined 4.4 million by the Information Commissioner's Office. So they were attacked last December, and they got fined this week. And this was for failing to keep personal information of their own staff secure. The attack happened. The attack happened in May 2020, and they've only just been fined this week. And they failed to put appropriate security measures in place to prevent the cyber attack, and it enabled hackers to get hold of 113,000 employee records, and as highlighted by the attack vectors, this was through a phishing email, which isn't surprising. Another attack to Gloucester City Council. So they had an attack that has been attributed to Russian hackers, and they've been told it's going to cost them upwards of about £1 million to fix. Current costs apparently sitting at 787,000, and the costs are still increasing. The attack impacted their benefit payments, planning applications, house sales. These are all delayed because their IT systems were compromised, and they had to completely rebuild their whole network. And again, the harmful software that uploaded this ransomware was embedded in an email that was sent to a council officer. So that just shows the cyber threat landscape as it is now. I'm going to hand over to James to discuss how that's impacting upon cyber insurance.
So thank you, Rory, and hello, everybody. As you obviously got from the introduction, my name's James Donald, and I'm a cyber underwriter here at Zurich. So for my section of the presentation, I'm going to spend around 20-25 minutes discussing Firstly, the impact that cyber risk and the evolving claims landscape has actually had on the insurance market. Secondly, we're going to have a look at claims and the threat landscape, both using internal and external data. And then finally, we're going to finish off with doing a little bit of a deep dive into one of the large losses that we've actually been handling internally this year. So starting with the impact on the insurance market, I think it's only right to take this back year and actually look at 2021. And this was really where we start to see the beginning of the drastic change within the cyber insurance market. So as you can see on the slide, I've broken it down into a couple of high-level key areas, and I'm just going to run through them now. So firstly, starting with appetite, naturally, when you've got an exposure that's increasing in both frequency and severity, naturally this will lead to a lack of appetite, or at least a reduction in appetite from what it was previously. And this is absolutely what we started to observe in 2021. This was either carriers being unwilling to provide cover due to heightened risk requirements, or actually carriers being unwilling to accommodate new business and really go after and commit to growth strategy targets through a need of correcting potentially distressed portfolios due to the increase in claims volumes they were dealing with. From a limit profile perspective, limits did certainly reduce. I think most commonly, we saw 10 million limits reduced from a 5, both on a primary and an excess basis. However, particularly in the SME and the mid-market space, we also saw limit profiles reduced from even 5 million down to 2.5. Now, moving on to deployment and where people are actually trying to target their capacity when they were willing to issue this. Again, we saw a real kind of reduction in the appetite for primary business, with excess business being really the key target. Naturally, the rationale there is that you're getting that added layer of protection that you would if you were going after primary business. Now, obviously these changes in the market had a significant impact on the underwriting process, and I'm sure everybody here is alive to that. It went from what used to be a single proposal form and potentially a handful of questions to, more often than not, a proposal form, a ransomware supplement, and then also quite an extensive list of questions that would accompany that. So I think from an underwriting process point of view, it required the market to come together and create quite a robust process. And I do personally think that one of the outcomes of this is that we've actually created quite a sustainable underwriting process. Now, obviously, it goes without saying that rate was significantly impacted. As I think a shared view was that, generally speaking, risks weren't adequately priced across the board. And I do also think it's fair to say that a shared opinion amongst most people in the market is that we have actually undergone a true price correction rather than just incurring significant rate increase. And not just to focus on the premium aspect of rate, I do think that retentions underwent a true correction as well. And I do think what we're left with now is a material increase across both premium and retentions, but I don't necessarily think that this will necessarily increase going forward as a result of this being a true correction. Now, a lot of these themes continued from 2021 into 2022. However, sitting here in the back end of 2022, looking on to 2023, we're already starting to see some changes in the impacts that I've just went through. So, from an appetite perspective, there's undoubtedly an increased capacity from new entrants in the market, which is driving competition. However, I think the main driver of the increased competition, I personally think, is due to just a restored appetite and faith of the existing carriers who, as a result of that robust underwriting process they've now implemented, as a result of clients being, more willing and accepting to take retentions and premiums that they feel comfortable. I do think this has been the key driver. And obviously, a year, if they were correcting distressed portfolios, they're now a year on and have probably, done the work that they needed to do. We're already starting to see in pockets the limit profile starting to increase. I do think this is certainly going to be a big theme for next year in 2023, and I think we're going to see this commonly. I think it's going to be a common strategy to defend renewals in particular. So I definitely think this is worth keeping an eye on. Whether those 5s go back up to a full 10 or whether it's incremental and going up to a 7.5 next year and onwards, I do definitely think this is something we're going to see. Already we're seeing primary business being more heavily targeted, and those low excess positions are very competitive. So again, starting to see more of a shift as a result of the greater confidence in the market. Now, from an underwriting process point of view, I don't actually foresee this changing a great deal, and I actually do think it would be a bit of a shame if we start to scale back and unravel, the extensive work that, as a market, we actually put into place last year, because I do think what we're left with today is a very sustainable underwriting process that ultimately benefits all three parties. From a client's point of view, from you guys on the broking side, and from an underwriter, we're all kind of alive to what is required to firstly get a cyber insurance policy, and secondly to ensure certain you're able to kind of accept and drive certain terms there. So I think it would be a real shame if we would actually unravel this process. Now, what I think we should do and could do from the underwriting side is show a little bit more flexibility. Conscious of firstly the time and effort that clients are putting into the risk controls. Secondly, being alive to the increased competition. I do think, as a market point of view, we can be a little bit more flexible in terms of maybe what we require is minimum controls. And I also think, for example, if a client has particular gaps but in 30 to 60 days post buying, those gaps will be filled, as an underwriter, is that necessarily worth, kind of taking the increased risk for such a short period of time, if that means that I'm going to, onboard what will then be a very good quality risk. So I do think we can show a little bit of flexibility. Now, finally, finishing off with the rate perspective, again, the fact it was a price correction, I don't actually foresee this changing significantly. Obviously, this can be driven by changes in the client's exposure, potentially revenues may increase or decrease significantly. So even if the claims landscape stays the same, this will obviously factor into rating quite heavily. However, I do think rate will stay there or thereabouts, and in some cases clients could expect a discount, flat rate, or an increase. But I do think increases will now be more in line with other lines of business. I would be quite surprised if we are seeing the huge significant rate increases that we have seen in some instances over the last 2 years. Now, obviously, this is very difficult to forecast, and I'm certainly not sitting here, put my name on the fact that people won't get material rate increases, but I would be fairly surprised if we do see that. I do think one thing that is likely to drive it, if anything, would be the global uncertainty amongst the various geopolitical situations that are ongoing. Obviously, the Russia-Ukraine conflict earlier this year clearly had what looked like a material impact on the market, and so this is something that is incredibly hard to account for, and ultimately has such a significant impact on our market. Next slide, please, Rory. So moving on to the threat landscape and kind of building on some of the key points Rory touched upon earlier. When we were putting these slides together, what I really wanted to avoid was to regurgitate, a lot of the things that I think you will probably already know. However, starting with the first point, it would be, it wouldn't be right to, discuss cyber claims without at least touching upon ransomware, with it absolutely dominating this space. Now, one point I wanted to mention, which I think is fascinating, is the fact that a staggering 86% of ransomware attacks in Q2 this year actually included data exfiltration. And this is certainly a trend that we've been monitoring since, I would say, probably the back end of 2021. Now, data exfiltration, for those of you who may not be aware, is what's happening is, the typical ransomware model is still going forward. Malware is infecting systems, threat actors are encrypting systems, and then they're, asking for a demand in order for the decryption key. Now, the added data exfiltration method is actually saying where the threat actors are stealing data, and they're going through the usual process, demanding a ransom, and saying, well, as added leverage, here's either, masses of either commercially sensitive information or third-party customer information. And I guess the rationale here from the threat actors is they know that the client will be, or the victim, sorry, will be very nervous of regulatory action, reputational damage, and obviously third-party privacy exposure off the back of this, and the longer-lasting impacts. So it's no surprise that we're seeing, most ransomware attacks actually incorporating this added leverage. Now, excuse me, moving on to the types of clients and the sectors that are being targeted. We're still observing a broad range of sectors being targeted, and I don't really see this changing anytime soon. However, some sectors naturally do have a lot more activity than others. The manufacturing sector seems to be very active in the claims environment at the moment. The technology sector has been targeted, particularly those firms who offer either hosted or managed services. There's been a handful of real household market leading names within the space that have been targeted over the last 18 months that have made the headlines, and I'm sure you could name at least a few of those straight away. The public sector continues to be targeted, and I think this has been the case for quite some time, and will probably is unlikely to change for quite a while. However, the private sector is being hit, frequently as well. So it's still a very volatile space. Without sounding cliche, no firm is safe. But if clients keep demonstrating, a real keen and positive attitude towards cybersecurity, all they can do is simply reduce the chances of a successful attack coming through. Now, one of the graphs that I've got on the screen here, we're talking to the ransom demands. Now, what I thought was really interesting here, and hopefully really useful for you to take away, is despite the fact that ransom demands themselves continue to increase, we can actually see on the graph here that there are actually less victims that are willing to pay the ransom. Now, this obviously begs the question, why is this? What is actually driving victims to feel the need that they feel less of a need to actually pay a ransom? And I've broken it down into a couple of high-level areas here. Firstly, I think we can't overlook the fact that clients' awareness and attitude towards cybersecurity is simply increasing. We're seeing year on year, whether it's either renewals or pieces of new business that we're seeing year after year, clients' controls are undoubtedly increasing and getting stronger and stronger. And if a client has, a strong security posture, with the likes of, say, offline backups, where even if their systems were encrypted, they can successfully restore from isolated and clean backups, then that really does reduce their need to pay a ransom. So I think this has absolutely been a key driving factor here. Secondly, I think the popularity of the ransomware as a service model breeds less trust in the capabilities of threat actors. So why would you therefore risk paying? Now, for anybody on the call that is potentially unfamiliar with the ransomware as a service model, this is essentially a franchise model where the key threat actors, the key organized crime groups and ransomware groups actually sell their technology on the dark web. So anybody that has access to the dark web and has $50 to $100, really small fees, can actually buy this malware and then can launch their own ransomware attacks, and then they would give a percentage of the profits back to the organized crime groups. Now, this is being made widely, it's being made public knowledge and is really growing in popularity. Now, from a victim's point of view, the only real reason you would pay that ransom is the hope that you would then get the decryption key and regain access to your systems and your data. Now, if that kind of trust in the system or the process reduces, and you're actually very unsure that you'll actually gain that, you're parting with millions of pounds of your money, but you're not even sure you will get the decryption key, then you're much less likely to pay. And I definitely think this is one of the driving factors in the reduction in ransom payments. Thirdly, and it goes absolutely without saying, that the regulatory environment, including sanctions, making the payment of ransoms more complex and high risk, is undoubtedly having an impact in this space, as companies will be certainly nervous to make a ransom payment for fear of breaching sanctions and recurring backlash down the line. And then finally, I think in terms of the uptake of cyber insurance policies, it is increasing year on year, but I do think that compared to other lines of business, we still have a long way to go in this respect. However, I do think that the more companies that have a cyber insurance policy reduces their need to actually pay a ransom. And there's some really interesting statistics we have here that shows that approximately 46% of all customers actually choose to pay a ransom demand. However, looking at our internal data at Zurich, only 20% of Zurich customers actually choose to pay the ransom demand. And I think this really does go to show and highlight the importance that holding a cyber policy has, and the fact that it does not just reimburse you for the ransom payment itself if you chose to go down that route, but we're obviously covering all the third and first party losses that would occur as a result of the ransomware loss or just the cyber loss in general. Now, furthermore, in terms of the actual frequency of attacks, attack volumes did appear to slow down in Q2, Q3 this year. Now, this looked like it may have been related to Russia-Ukraine conflict, but obviously that's very, very difficult to draw a direct correlation. But it was fairly coincidental in terms of the timings. However, frequency has notably started to increase again over recent weeks, so that is certainly something we're trying to monitor. Now, hopefully, this next stat will be of interest to you all. Firstly, because it's everybody's favorite acronym, MFA. I'm not just confident that everybody on this call knows what MFA is. I'm even more confident that you're all sick of underwriters like myself sitting here talking to you about MFA in some form or another, as that's certainly been one of the key themes over the last few years. However, what I think is really interesting to discuss around multi-factor authentication at the moment is the fact that one of the claims trends we are starting to monitor is actually the rise of ransomware claims that are actually stemming from MFA fatigue. Now, this term MFA fatigue is where a threat actor will spam a user's MFA prompt in the hope that they get fed up and click accept. So if that was me right now, I would have my work phone. I need to satisfy the MFA requirements to gain access to my systems because I'm sat working remotely. Now, the way an MFA fatigue, I guess, attack would work would be I would have 5 prompts, within quick succession. I would probably ignore the first 4 and then potentially get fed up on the 5th one, click accept. And what I'm actually doing there is I'm satisfying the MFA requirements, and I'm actually giving the threat actor access to my credentials and system access as a result. So this is very, very concerning because, I'm not at all saying that MFA, particularly for remote access, is not essential. I think it is and will always be one of the most essential controls we have in, reducing the likelihood of a successful attack. But what I'm trying to get across here is it's potentially not the kind of silver bullet that we may have thought it was recently in recent years. And I think this really emphasizes the importance of employee awareness training, not just focusing on phishing attacks, but focusing on, the new attack vectors that threat actors are coming up with, because we all know here that they're very sophisticated and they're always evolving and looking for clever ways to bypass even the most secure cyber risk controls that we have in place. Now, moving on to the privacy element for a moment here, data breaches are clearly on the rise. As a result of the ransomware model, makes a lot of sense with the data exfiltration element being used in conjunction of most attacks. And even look in the last few weeks, we've noticed or observed, large losses or large breaches in the UK, Australia, and the US. So it's not even jurisdiction specific. We're seeing this as a real global issue. And then finally, what I think is particularly interesting for the audience on the call here, moving on to the other graph that we have here on the screen, is that the actual median size of companies targeted in Q2 2022 has actually fallen. So it's quite clear that threat actors, following on from Rory's earlier comments, that threat actors are actually targeting smaller but financially healthy companies, where the risk to reward profile is more consistent and presents a lesser risk than if you're targeting a large organization that would lead on to a high profile attack. Next slide, please, Rory. Now, finally, this is what I wanted to walk you through. One of the large losses that we've been dealing with this year. There was a few reasons why I wanted to do this. One, because it's a manufacturing loss, and we, as I mentioned earlier, we're seeing a lot of claims activity within this space. And secondly, despite the fact it's a manufacturing loss, there was actually some fairly interesting nuances with this loss that I think are worth highlighting. So in order to set the scene, what we've got here is a large UK manufacturer, Blogs Limited. So, Blogs, the first 24 hours, Blogs identified that some of their systems were not performing as expected. After an initial investigation, they realized that an unauthorized third party had actually encrypted a number of Blogs servers and had left a ransom note. So at this point, they were aware this was a ransomware attack. The internal leadership group were advised that the disruption to several IT systems was to be expected, and therefore they should invoke their business continuity plan, which is certainly something we ask of all of our customers. The attack was found to be contained to the infrastructure of Blogs' local manufacturing sites, also a head office, and then in addition to that, there was also some certain file servers that were located in the database that had been impacted. Now, the threat actor in this instance, had exfiltrated some data, so tying that back to the trend that we're we're observing both internally and externally, in addition to encrypting the rest of the systems and the data there. Now, fortunately, most of the exfiltrated data was not commercially sensitive. However, it did include some personal data. Now, what I think is really interesting here was that whilst it is increasingly common to see data exfiltration used in conjunction with ransomware attacks, it is actually very uncommon to see privacy breaches stemming from cyber losses within the manufacturing sector. And this is usually because it's typically uncommon for a manufacturer to store or collect large quantities of data because they usually operate business to business and therefore they would have no need to. Now, every business holds employee data, and therefore, this is a best case scenario when assessing a client's privacy exposure. Is collecting employee data is simply unavoidable, and we like to think that employees are usually less likely to seek compensation against our customer than a third-party customer would. The first 48 hours and beyond. So obviously we worked with blogs very closely. We appointed expert third-party suppliers, and we supported the client through their notification process, which included their customers, regulators, and the impacted individuals. Now, steps were also taken to ensure that the incident was isolated and contained, and that no further data was to be either encrypted or exfiltrated. Another interesting point of this loss was the fact that in this scenario, experts actually decided to engage with the threat actor, and they actually took the professional opinion to actually pay the ransom. And then following a very successful negotiation, the original ransom demand started at in excess of €7 million, and was actually finally negotiated at less than 3 million. So, very successful negotiation there. Next slide, please, Rory. And then finally, the longer term and present position for blogs. So the manufacturing process was quickly brought back into operation, and IT systems were gradually brought back online. Production wasn't brought back to 100% capacity, but they were able to continue operations to some degree. Now, another interesting factor about this is that when we're assessing manufacturing exposures, a large part of our underwriting process focuses on the client's reliance on operational technology. Now, in this instance, the client didn't have a large reliance on operational technology. They had manual workarounds in place if their systems went down, and yet still we incurred very large and very significant increased cost of working. And I guess an example of where these costs came from. The client had a production line, very kind of old school, and it had a robot on the end that would scan the barcodes of each product to check that the barcodes were appropriately matched to each product. Now, when this robot went down, instead of having that technical capability there, the client then had to put 3 or 4 members of staff on the end of the production line and then had to manually check each barcode. Now, if they're having to do this for several different points of the production process, 24 hours working, different shifts, and that goes on for months and months, suddenly you start to incur very, very material costs. So this was certainly kind of a lesson learned from our perspective. The total period of disruption was approximately 4 months, and following, Zurich undertaking various sanctions and regulatory checks, we were able to successfully indemnify the client for the ransom payment they made. Obviously, the client has to make the ransom payment themselves, and then as an insurer, we would then reimburse that payment. Forensic accountants were appointed to advise and assist with the business interruption element of the loss, which is always a very, very tricky element. And I think we can't underestimate the value that providing these experts under the policy really supports the client in. Sticking with a similar tone, the legal panel that was appointed within the first few days of the loss stayed with the client and is still with the client now, trying to mitigate and manage the long tail privacy exposure that they're facing. And then finally, the client's risk posture actually benefited as a result of this loss due to the improvements they made. Unfortunately, this is the very definition of learning the hard way. You're made aware of certain vulnerabilities because a threat actor has actually exposed them. But what we do see more often than not, particularly following a year or 2 years following an attack, clients have a very different attitude, or at least an improved attitude towards cybersecurity, and more often than not will invest heavily into improving their risk framework, which actually does usually improve the risk overall. Now, finally, to wrap up this section, despite the threat landscape continuing to evolve, continuing to present a significant exposure, the one message I want you all to take away today is that we are absolutely very much open for business. You know, we've got really ambitious growth strategy targets. We're trying to write as much new business as we can within the territories that we're targeting. So we do have a lot of confidence in our underwriting capabilities, despite the fact that it's still a very volatile and difficult market to operate in. And we will always try to provide a tailored risk transfer solution, for our customers. Now, for those customers that currently fall a little bit short of our minimum risk requirements, you know, we may not be at present in a position to offer them a risk transfer solution, but what we can offer at Zurich is a risk improvement solution through our ZRS proposition. And I'm going to hand back over to Rory now, who's going to spend the remainder of the presentation walking us through the range and breadth of services that we can offer in that respect.
Yeah, thanks, James. Some really interesting points you brought up there, and especially around the your client there, the manufacturer who learned to improve their cyber posture the hard way. And hopefully with some of the products that ZRS can provide, we can help organizations do it the easier way and improve their posture before they're actually attacked. So first of all, I just want to start with quickly go, who is ZRS? Who is Zurich Resilient Solutions? So we provide insight into core, new and emerging risks with the goal of reducing risks to organizations. And we do this through our risk engineers, who globally we have more than 750. And we have a range of solutions ranging from liability, climate change, supply chain, property and energy, well-being, resilience. But today I want to talk to you about cyber resilience and our proposition. So as I mentioned at the start, there are 4 ways to treat your risk. One good option, of course, as James has spoken about, is risk transfer and get cyber insurance. But in my opinion, the best way to treat risk is to mitigate it, put controls in place, lower the likelihood of a successful attack, and also lower the potential impact if anything were to happen. First of all, I want to talk about our cyber health check. So in simple terms, this is like taking your car for MOT, but instead of checking if the car is roadworthy, you're checking if an organization's cyber posture is at a level it should be for an organization of their size. And it's a really good starting place for an organization. It tells them where they stand regarding their cybersecurity posture, and then we identify their control gaps, further recommendations on how they can improve and get them to that next level. And these recommendations are really tailored to the size of the organization and their maturity, because we need to be realistic in our recommendations. We can't take them to nothing. We can't take them from 0 to hero, because some of these organizations don't have the capability or budget to put these security controls in place, and neither should they with their risk profile, as the costs will outweigh the benefit. But it is these tailored recommendations for our customers that really provide them with benefit. But not only that, these control gaps recommendations that we provide are really good at obtaining senior management buy-in for future cyber programs, but also helps them plan what those programs can be, as well as their priorities, as the recommendations come with severity levels, and it provides them with a practical roadmap on how to improve their cyber risk management. We also have cyber awareness. So as we've seen, phishing is the biggest threat vector for cybersecurity attacks. When you click on the malicious link or input your username and password, and these phishing attacks are becoming much more complex and believable. Even myself, a couple of months ago, I fell susceptible to the Zurich phishing attack and fell for the DocuSign one. You know, so it does happen, and there are technology solutions out there that will help mitigate this risk, but the best mitigation is to make your staff more cybersecurity aware. And in our proposition, we help develop a cybersecurity awareness strategy, identifying their current maturity and creating an action plan, get them to that next level, and we can also provide them with the materials to help them implement these actions. Next, we have incident response, which I would say is one of the biggest control gaps that we see across sectors, up and down organizational size. This is where a lot of organizations fall short. As we've seen, the likelihood of successful attack is increasing, so plans need to be in place for when this actually happens. So we can help organizations create incident response plans, but we can also help them test these incident response plans with tabletop exercises, because it's a very common theme that we've seen that organizations might have a plan, but they haven't tested if it's any good or not. They have no idea if it's going to be effective. And the benefits of this service is that it improves the maturity of their organization's incident response capability, as you're able to incorporate lessons learned from the exercise back into the plans, but it also helps improve the awareness of incident management at the senior leadership level, as we like to get the senior leaders involved, and sometimes it's actually the first time that they're truly aware of the impact it could have on their organisation. We do cyber risk management assessments. So as stated at the start, everything comes back down to risk. If you haven't identified your assets and the impact of these assets should a vulnerability be exploited, then you can't determine what controls to put in place or even if they're effective. So this proposition, it focuses on looking at their current cyber risk profile and identifying their key risks against their critical assets, systems and services, and then give them a practical roadmap to improve their risk and actually give them the opportunity to make informed cost-based decisions. Moving on to virtual security. So this is something that's very common within the smaller, more medium enterprises, the fact that they don't have any dedicated cybersecurity personnel. Maybe it's a secondary role for someone in IT, but they generally don't have the skills or knowledge or the time to be as effective as they like, despite being very capable people. With this virtual service, we can provide organisations to that right mix of cyber expertise and knowledge on a retainer to help deal with any day-to-day or ad hoc challenge that they have. And the reasons that these organisations don't have dedicated personnel is they're very hard to get hold of, they're very costly. But with this service, they only have to pay for what they need, making it much more cost effective. And then looking at the supply chain, I'm sure we're all aware of how important the supply chain is, and it's no different within the cybersecurity world. And we're increasingly seeing more cyber incidents occur due to attacks on the supply chain. And this is because a single supplier can compromise a whole network of providers. And with this service, we can look at individual suppliers to an organisation, providing recommendations and appropriate controls, etc. But what we'd like to do is help them implement a more robust process when it comes to cybersecurity in their supply chain and build that out. And we also offer bespoke consultancy around policy reviews, strategies, business continuity, etc. But I want to mention that the fact that cybersecurity is people, process, and technology. The ZRS proposition focuses heavily on the process and people elements, and this meant there was a technology gap within our proposition. So we have partnered with an organisation called Barrier, and they've helped us fill this gap. I believe it complements our proposition superbly, giving us a much better, well-rounded offering. They're a private UK company, very good reputation. They've worked across multiple sectors. They're even currently working with the UK Space Agency on securing satellites. They've partnered with all the leading technology vendors that you'd normally expect, your CyberArk, Cisco's, your Microsoft, etc. And the range of services that they offer are your managed cybersecurity services. So where an organisation might not have the resources or the want to conduct their own security, they can offload that to Barrier, and they'll undertake that for them. And they can also provide network or endpoint security solutions, or SOCs, or security operations centers. They provide technical assessments, so they do any vulnerability assessments or penetration tests that we require, or a client may require. And they also have a cyber incident response service. So where we were focusing on building incident response plans, testing those plans, Barrier are the first responders. So they come to contain any cyber equivalent of fire. Of course, if you have insurance with Zurich, this comes with it anyway, with the Zurich's provider. But for organisations that are unable to gain insurance, this is something that we can offer, where they can have instant response on a retainer. And then once the incident is over, Barrier then the forensics experts who then piecing all together, collect and preserve the evidence and of the cyber incident. They also do technical consulting, so this is much more on the architecture of an environment, how to build it securely, for example. And they also have cyber awareness capability. So where we are focusing on building the strategy, Barrier will provide the technical elements of implementing the action plan, be that any learning and awareness platforms that need to be tailored or phishing tools. This is something that they can provide. And they're also licensed to assess and certify against Cyber Essentials. So Cyber Essentials is the government-backed industry-supported security standard, and it helps organizations protect themselves from the most common cyber threats. But you need to be licensed to be able to certify this, and it's something that Barry are able to do and to help us with. And then finally, as it's been a bit of a common theme for some things that I've spoken about and as James has spoken about, and that's operational technology. Operational technology is the hardware and software, for those that you're unaware, that monitors and controls industrial equipment. So you think of that factory floor, it's the operational technology that is monitoring and controlling it, it's monitoring all the sensors. Over the years, operational technology has become more interconnected. This was to enable better analysis and control. Some cases, this has resulted in it being directly connected to the IT environment, or in some cases, the internet. As well as this, operational technology is old. It works, so why would people change it? But it's also very sensitive to change, so they can't be updated with security patches, or they don't tend to be, because it can create absolute havoc within the environments. And because of this, it creates a number of security concerns, as you can imagine. And as James will attest to, operational technology is becoming a larger concern for the cyber underwriters. And the reality is that specialists required for operational technology are very scarce. But Barry has in-house specialists that we can leverage for our customers, and they provide risk assessments, managed security services, network modeling, everything you normally expect, but for the operational technology environment. And that concludes our discussion here today. I'll say thank you for listening, thank you for your time, and I'll now hand back to Heidi.
Lovely. Thank you very much, Rory and James. That's a really, really interesting session. We've got a couple of questions in the chat box already, but if anyone has any other questions, feel free to pop them in there now. So first one from Joel. Zurich always used to have a cyber SME product available on eTrade. Will this be brought back?
Yeah, so firstly, thank you for the question, Joel. It's certainly an interesting one. There are certainly no plans to bring it back. I would be surprised if we saw this brought back in the near future, and there are a few reasons for that. But I think fundamentally the key challenge here goes back to the enhancement in the underwriting process that I touched upon in the presentation. When we had this this online e-trading model, we were only asking, the client had to meet, I think a very, very minute amount of requirements, and therefore, now in 2022, going out 2023, when we were alive to the fact that the claims landscape and the actual cyber risk environment is much more complex than simply ticking a couple of boxes, I think it would be very difficult to create a platform that would satisfy our requirements at Zurich. Now, that absolutely doesn't mean that other carriers can't and won't be doing it. So I'm not sitting here saying it's impossible, but I do think for the standards that we hold ourselves to, I can't really see it happening. Now, obviously, look, things may change in the near future. We may do something, but I think, at least for the time being, I'm not aware of it, and I think it's fairly unlikely.
Okay, thanks, James. Question from Luke. Does All-Will ZRS offer penetration testing?
Yeah, cheers, Luke. I saw this one pop up just before I mentioned penetration testing. So it's something that ZRS directly doesn't provide, but something through our partner Barry is something that they provide for us.
Thanks, Rory. There's no other questions in there at the moment, so I'll just leave it a few more seconds in case any others pop.
And if there are any questions that you think of at a later date, feel free to message myself or Rory directly, and be more than happy to pick that up.
Thanks, James. I'll include both your contact details in the follow-up email, so anyone can get in touch if they have any other questions. We've had one other from Nick, who has said, James, you mentioned that the market has come together to produce an underwriting process that avoids multiple forms and lots of supplementary questions. I haven't seen with the markets we deal with, is there a move to standardise proposal forms or question sets?
So firstly, apologies if I wasn't clear there. Whilst that would be, that would be the dream outcome to avoid all of this. The point I was trying to make was that 2021 actually saw us introduce, the need and requirement for multiple forms, for long additional question sets. So that was more of a reflection of that being brought in rather than that being phased out. Unfortunately, I actually haven't seen any standardised proposal forms. However, what we do see are a couple of markets, where their forms are widely used. So, for example, Beasley's forms are widely used and accepted. Same with AIG. So, whilst they're not standard forms, they are pretty common. And I do think that does help to streamline the process to a degree. Here at Zurich, we try to be as flexible as we can in this process. We don't require our own forms like some carriers do, and we're typically happy to accept anybody's forms and would try to just plug the gaps with additional questions. So yeah, again, apologies if I wasn't clear there.
Thanks, James. Not had any other questions at the moment. We're nearly at 3 o'clock anyway, so we'll close the webinar there this afternoon. And as I said before, if you do have any other questions, feel free to get in touch with James or Rory afterwards, and they'll be very happy to discuss any questions you've got further with you. But thank you everyone for joining this afternoon, and of course thanks to James and Rory as well for delivering a really interesting presentation, and hopefully see you soon at another one of our webinars in the upcoming months. Thank you.
Yeah, thank you everybody.
Thank you, Anna.